This chapter deals with the stylized facts of economic growth, or the patterns in the data that we would like to explain with our models. And the sources that I can recommend here are the chapter by Charles Jones, The Facts of Economic Growth, published in the Handbook of Macroeconomics in 2016. And the following two websites, Our World in Data, that provides rich data sets of cross-country development aspects over longer periods of time. So it's really rewarding to have a look at the data there. And of course, World Bank's World Development Indicators database, which is also very rich in cross-country data going back a few decades that one can analyze and try to explain with the economic frameworks. Now, the first crucial aspect, if we want to analyze economies in the long run, is to sort out the kind of questions we are interested in. And in macroeconomics in the long run, we are mainly interested in two aspects. One is the comparison of living standards across different countries, where living standards are typically measured in GDP per capita, which relates to questions such as why are some countries rich and others poor, so one of the most fundamental questions in economic growth theory and in macroeconomics in general. And this can be asked in a more specific way that we observe at the same time people in rich countries in huge affluence with iPhones, diet coaches, and so on and so forth, while at the same time people in poor countries starve. And the question is, why is this actually the case? And the second question is closely related and asks how we can explain the evolution of living standards over longer time horizons. So, for example, why did living standards stagnate prior to the Industrial Revolution? So there was no growth in per capita GDP at that time period. People lived close to subsistence for basically centuries. And then there was a takeoff of economic growth during the Industrial Revolution, and since then we observe sustained economic growth. But this is quite a short time period that we observe sustained economic growth when we compare it to the whole history of humankind. Then another related question is, how do new technologies affect economic growth? What is the driving force behind economic growth? And when we analyze this, we find out that technological progress plays a crucial role in this aspect. And another interesting question in this context is what explains the so-called economic miracle in countries after the Second World War, such as Austria and Germany, where the per capita GDP was very low and comparable to levels in the 19th century, directly after the war. And many people believed after the Second World War that these countries would not be able to grow in the near future. But despite this fact, an economic miracle, or back then it was called an economic miracle, occurred after the Second World War, in the sense that countries such as Germany observed growth rates at the order of 7% and higher per year. And this was unseen in economic history before, and it was termed the economic miracle. And if we look at this from the lens of economic growth models, we will see that this is not so much a miracle after all, because it's actually predicted by frameworks such as the solo growth model. I've already mentioned that GDP plays a crucial role in measuring actually the evolution of economic strength of countries over time, or the dispersion in different countries' income levels across the world. Now, you know from introductory macroeconomics classes that aggregate GDP of a country is the value of all goods and services produced within this country in 1 year, and as such it's a measure of economic strength. But if we want to relate it to well-being as such, or to kind of the prosperity of a country, a number of issues actually pop up. And the first and most important one, obviously, is that if we look at aggregate GDP, then a country with a large population could have a very high level of GDP, yet it could be very poor at a per capita level, because there are so many people, basically. And if you divide aggregate GDP by so many people, per capita GDP, or per capita income, which is the same in a closed economy, would be much lower. Compare, for example, Nigeria versus Luxembourg. where Luxembourg has a very high per capita GDP, but the economy is not very large at the aggregate level because not so many people live there. And in Nigeria, it's exactly the opposite. The economy is much larger because so many people live there, but per capita GDP is very low. So one thing that we need to take into account is differences across countries in terms of the population, and to compute per capita GDP instead of aggregate GDP in this case. However, even this adjustment does not take into consideration that there are differences in purchasing power across different countries. For example, think about having 100 US dollars and spending them in the United States, or spending them in a rather poor country, say in Nepal. The $100 with $100 you can afford much more actually in the poorer country. The reason is that wages there are low and things cost less, basically, particularly the non-traded goods. And therefore you can purchase more with the same $100. And if we want to compare well-being, economic well-being and incomes across countries, then we need to take these purchasing power differences into account. Then a more specific problem is that GDP is a flow measure. It measures the value of goods and services produced in a country within 1 year, but it's not a stock variable. And we could reasonably claim that we are not so much interested actually in the flow of the production of goods within a country in a certain period of time, if we want to kind of make welfare statements, but more on the stock, how well is such a country. And of course, this difference that GDP is a flow measure and not a stock brings a lot of other consequences, like the one that is mentioned at the bottom here, that some damages, catastrophes and so on, are not adequately captured, because actually they would imply high GDP because you have to rebuild the economy and you have to reconstruct things, and that creates, of course, more production and more services in the short run. So this would lead to an increase in GDP, although these damages, catastrophes, wars and so on actually reduce well-being quite a lot and destroy the stock of wealth, if we want, in an economy. In addition, GDP includes depreciation, so a high depreciation would cause a high level of GDP, although depreciation is actually nothing that is good in this sense. It measures how fast different machines break down, and the capital stock actually loses in value. And then, of course, only goods and services bought and sold on markets affect GDP. But one could think about lots of different ways to organize, for example, childcare in a community where it is not formally paid. And it's not clear why a country that organizes, or a village in this case, organizes childcare at the market-based wage rate where somebody is paid would be better off than if this is organized kind of privately and nobody is paid for, just everybody does his or her share in this taking care of the children. And all these issues, of course, mean that GDP and per capita GDP has a lot of flaws if we use it as a well-being indicator. This was well known actually also to the person who is credited with the invention of GDP, Simon Kuznets, who warned against its use as a well-being measure or a welfare measure. Now, irrespective of this, per capita GDP is widely used, and we will do the same here, but there are two necessary things that we definitely have to do. And the first is to divide by the population size and look at GDP per capita and not at aggregate GDP. This should be clear, because, as I said before, you could have a large country with a large population where still everybody is comparatively poor if we just look at aggregate GDP. And the second is we need to do a purchasing power adjustment to adjust for the fact that $10 or $100 can buy you more value of goods in Nepal than in the US. And this is typically done by comparing at an international level baskets of different goods and use them to compute price indices, and with these price indices do a purchasing power adjustment such that the final currency that is computed, the so-called PPP-adjusted international dollar, is then a currency that is comparable across countries and is purchasing power adjusted. If we look at purchasing power adjusted real per capita GDP across countries, the data here are from 2019 from the website that I mentioned before, Our World in Data, then we see that there are huge differences across different countries. We see that the darker the color is here, the blue is, the higher is per capita GDP, purchasing power adjusted, and the lighter it is, the lower is per capita GDP. And if we go to this yellow part here, per capita GDP is very low. We see the rich countries are mainly concentrated in Northern America, United States with a very high per capita GDP level, some countries in Europe such as Norway, Sweden, the Nordic countries, Ireland, which was comparatively poor just a few decades ago but managed to grow rather quickly over the last decades. And then Central Europe, we see Switzerland, the Netherlands, Germany, Denmark, Austria, with comparatively high per capita GDP levels. Also Australia, and then some oil-rich countries such as Saudi Arabia, Qatar, the United Arab Emirates, and some other countries such as Japan and South Korea, comparatively rich, and Russia here as well, because mainly due to the oil revenues and so on. Then we see some areas with a little bit lighter color here in Southern America and also in Asia. So China, although it has grown very quickly over the past decades, is still below the level in terms of per capita GDP than European countries and then Northern America. And then some other countries such as India, Pakistan, Bangladesh, Thailand have even a lower per capita GDP level still. And the poorest countries tend to be located in Africa, particularly in sub-Saharan Africa, where many countries have very, very low per capita GDP level. And one of the main goals of economic growth theory is to explain why some countries are comparatively rich and others are poor. And this is what I will do in the videos on economic growth later on, and to propose frameworks that can address this question from a growth perspective. Now, as I said before, there are quite a lot of issues with per capita GDP as a measure of well-being and even as a measure of economic production. But nevertheless, it's widely used in economics. It's one of the main indicators that we talk about, that the news reports about, that international agencies are concerned with, and so on and so forth. And one might pose the question why this is the case. And I think there are a few reasons for that. One of the main reasons is that per capita GDP is comparatively easy to calculate compared with other indicators such as the Human Development Index, which actually contains GDP, but two more dimensions such as education and health. And therefore it's clear that per capita GDP is easier to calculate and is available for more countries over longer time periods. Then another alternative would be to make surveys about happiness, how happy the population is. But of course, they are quite work intensive, data intensive. You have to collect these surveys. Ideally, you would ask the same people over time, which is clearly not feasible in reality, and so on and so forth. So as compared to these approaches, per capita GDP has the advantage of being comparatively easy to calculate, having a straightforward interpretation, and being available for many countries over many years. However, even if we abstract from this data availability issue, there could also be made an argument in favor of per capita GDP because it's highly correlated and positively correlated with many of the aspects that people outside economics argue that they have to be taken into account, that they are part of a so-called good life, if you will. And this is health, typically measured in life expectancy terms, education, and life satisfaction and happiness from life satisfaction and happiness surveys. And if you do a comparison between these different indicators and per capita GDP, then what's frequently found is that there is a positive correlation that is typically also quite high. And for example, Jones and Kleno in a paper in 2016 developed a very refined indicator that takes into account not only income, but also leisure, consumption, inequality, health, and so on. And what they find out is that their indicator, which is based on a social welfare function and micro-founded in this case, is comparatively difficult to calculate. It's sophisticated but difficult to calculate. And for the countries for which they are able to calculate it, the correlation with per capita GDP, or with the ranking of per capita GDP, is still 0.98. So actually this very refined index that is difficult to compute, or indicator that is difficult to compute, still contains the same information as per capita GDP does. And another approach we've done with David Bloom and other co-authors, where we computed inequality-adjusted healthy lifetime income across different countries, which is basically 1 minus the Gini coefficient as an indicator for inequality, times the healthy life expectancy of people, which is an indicator of health, times per capita GDP, which can be interpreted as an inequality-adjusted income that a person earns during the years in which the person is in good health. However, again, if you build a ranking across the different countries of this indicator and of per capita GDP, then the correlation is again very high at the order of 0.95 and so on. So again, the indicator that considers health and inequality contains mainly similar information as per capita GDP does. So these are the two arguments. First of all, data availability and the fact that per capita GDP is easy to calculate, and second, that it nevertheless is highly correlated with other aspects that we associate with well-being and with a good life. So therefore, I do not use any different indicators at that point, and stick to the convention of reporting per capita GDP when we compare the living standards across countries and over time. And the first figure that we want to look at here is the evolution of per capita GDP over the last 2000 years, basically, for some different countries: the United States, Austria, France, the United Kingdom, South Korea, Argentina, China, Indonesia, and India. And what we see is that, as I said before, over the longest periods of human history, actually per capita GDP did not increase at all. There was stagnation. People lived close to the level of subsistence. Everybody was poor, if you will, perhaps just a small elite, the kings and so on. They lived above subsistence, but the huge majority of the population lived at the subsistence level. And economic growth as such was an unknown phenomenon. Everybody was poor, life was short and brutish, and basically this didn't change until about the Industrial Revolution. And when the Industrial Revolution occurred, where then countries such as the United Kingdom here pulled ahead, and the United States and some Western European countries, basically where the Industrial Revolution happened first, these countries experienced their economic takeoff first. And as a consequence of this fact that they experienced the takeoff first and then observed or exhibited comparatively constant growth over the next 150 to 200 years, there was a divergence, and these countries managed to pull ahead. So the United States would be the richest country among them nowadays, with the highest per capita GDP level. Then it would be followed by Austria, France, United Kingdom, so some Western European countries, then South Korea, and then Argentina here in Southern America, and then China, Indonesia, and India, countries that managed to grow very fast over the last decades, since the 1970s, but which had the Industrial Revolution, or at least the take-off to sustained economic growth, much, much later than the countries that were the forerunners in the Industrial Revolution. Now I took another picture from another data set from the website of Our World in Data, where the time period is now restricted from the Industrial Revolution, basically 1820 to 2018. And it's not individual countries that are displayed here, but regions, such as the Western offshoots, comprising United States, Canada, Australia, and New Zealand, Western Europe, Eastern Europe, the Middle East, East Asia, then the world as such, so the average, Latin America, South and Southeast Asia, and Sub-Saharan Africa. And what we see is that at the time of the Industrial Revolution, these regions were equally poor, basically. So the ratio of per capita GDP of the richest region to the poorest region was not very high. And then after the Industrial Revolution started to occur in the Western offshoots and Western Europe, a so-called great divergence emerged, with income levels of these regions diverging substantially. And if we look at the data again in 2018, we see that cross-country inequality has increased tremendously as compared to the time before the Industrial Revolution, during the early stages of the Industrial Revolution. So this is important. Inequality across countries was simply not present before the Industrial Revolution. All countries were basically poor, and only afterwards this huge divergence occurred, such that we nowadays observe the rich countries, as I said before, very affluent. People can afford many of the things that people in poor countries cannot even or would not even dare to dream about. So this is, from a historical perspective, how things evolved. And one of the frameworks that I discuss later on in the video, the Unified Growth Framework, actually explains why there was economic stagnation prior to the Industrial Revolution, why a takeoff occurred endogenously, and why we observe sustained economic growth since this takeoff in the richer countries, and why we may observe a delayed takeoff in some of the poorer countries. And what we also see here is that, as I said before, the Western offshoots and Western Europe would be the richest regions now here in terms of income levels. So here I use rich in a loose sense. Then Eastern Europe, Middle East, East Asia, the world average, and Latin America would be rather close together. And then it would be followed by South and Southeast Asia, and finally Sub-Saharan Africa, which really faced stagnation almost up to now. Now in this picture I focus on two countries, and this is a picture that pops up very frequently in my videos because in my opinion it really shows exactly those stylized facts that economic growth theory wants to explain and is to some degree quite successful in explaining. Here we see the logarithm of per capita GDP in the United States, that's the red line, and in Germany, that's the blue line, from 1850 to 2010. And a few things are now remarkable. First of all, despite the fact that these two countries experienced very different policies, very different historical events, or at least maybe the same historical events, but were affected differently by them. So here we see the Second World War, for example, where the German economy was afterwards at the level of per capita GDP as in the late 19th century. Despite this fact, the long-run growth rate is almost the same in these countries, and also the gap in per capita GDP levels remains the same in the long run. So the gap today is almost the same level as it was in 1850 in percentage terms, which is despite this huge difference in the two countries after the Second World War. So what I also said before is this convergence phase after the Second World War, something that people didn't expect at that time, and which was called the economic miracle. And that actually led to a situation where just 2 or 3 decades after the war, Germany already closed the gap to its previous growth path that it had until the Second World War, to the long run. So this is a convergence period that we also would like to explain. So it's a stylized fact of economic growth that we would like to explain that such convergence can occur. And we will see later on that this convergence phase can be explained comparatively well by the Solow model of economic growth. So these are the 3 main facts. As I said, we observe comparatively constant long-run economic growth, despite the fact that the countries are quite different. We observe a constant gap that warrants explanation, and we observe convergence phases after a war and after the capital stock of a country is basically destroyed. What we also observe here, and what I find really illuminating, is that this long-run trend, which is what economic growth theory tries to explain, dwarfs the short-run fluctuations. So the short-run fluctuations that we see here is what business cycle theory typically aims to explain, and what we read about in the newspaper, right? Here you see this small dip here is the Great Recession, but the Great Recession was actually in every newspaper. There was nothing else reported about basically economics in 2008 or late 2008. But nevertheless, we see that these fluctuations are dwarfed by the long-run trend, actually. And even here, the Great Depression is, if we look at it from a long-run perspective, just a quite short deviation from the long-run trend. Now, there is one question that is very important in this context, and this is, why does growth actually matter? And for this, I've provided a thought experiment that should clarify that even comparatively small variations in economic growth rates imply very large effects in the longer run. So here, assume that a country has a per capita GDP of $30,000 in the year 2000, and then it experiences a growth rate of 1% per year on average over the next 50 years to the year 2050. Then per capita income of this country would rise to about $49,000. But if this country had a growth rate of 2% per year, then per capita GDP would rise to a level of $81,000 in 2050. So that's quite of a large and sizable difference, and it's actually almost 3 times the initial value of per capita GDP in the year 2000. Now assume that the country would have grown even at the rate of 3% over this time horizon, then per capita GDP in the year 2050 would be $132,000, which is actually 2.5 times as much as it was in 2050 with a 1% growth rate. So the bottom line here is that if there is a policy that can change the economic growth rate only slightly, but over the long run, this is a policy that will definitely have a very large effect. And due to the fact of compounding interest, of these calculations of compounding interest, these small differences really lead to huge level effects in the long run. The next 2 slides are devoted to the so-called stylized facts of Nicolas Kaldor, who in the 1950s described a set of stylized facts that a useful economic growth model should be able to capture. So he described the following 6 facts back then that he observed for the countries over the first half of the 20th century and the end of the 19th century over the longer time horizon, and that is that GDP per capita grows at a non-diminishing rate, so a rather constant rate. Capital per worker also grows at a constant non-diminishing rate. The capital rental rate, so the rate of return on capital basically, is constant over long time periods. And the capital output ratio is also constant over this time. And as one of the consequences of that, the share of labor income in aggregate GDP is also constant over time. So the share of total income that goes to the production factor labor is constant, and therefore also the share that goes to the production factor capital is constant. So there is no long-run secular shift towards one of the 2 production factors. And finally, he observed that the growth of output per worker differs across the different countries. Now, what basically holds true is that these stylized facts hold in the long run, typically in the first half of the 20th century until the 1980s. But the stylized facts do not hold, the Kaldor stylized facts, over the very long run, so the Malthusian stagnation period is not covered by them. And since the 1980s, there are signs that the share of total income that goes to the production factor capital has been increasing, and typically the labor income share in most of the papers that I've seen that describe the evolution of factor income since the 1980s has been found to decrease. So the stylized facts of Kaldor can be used to evaluate growth models in the first half of the 20th century, but perhaps not beyond. But a reasonable growth model that aims to capture the development of many countries over many parts of the 20th century should be able to make predictions that are in line with the stylized facts of Kaldor. Now this concludes actually this small overview of stylized facts of economics in the long run that economic growth models should be able to capture. And here I just give a brief outlook of what the main models are concerned with and how they explain these findings that we've observed up to now. So how they explain the evolution of per capita GDP over longer time horizons and how they explain differences in per capita GDP across countries. And at the core of these models is typically a so-called production function, where a final output, which is aggregate GDP, and in a closed economy it's also aggregate income, is produced by means of physical capital. Physical capital are all the machines in an economy, all the production halls and so on, so all the capital with which one can produce. And labor, denoted by L, where labor is typically also augmented by human capital. So L would be raw labor and lowercase h would be the human capital, the average human capital in a society as determined by education, health investments, experience and so on. And it's clear that as human capital is embodied, it increases the productivity of the production factor labor. So it appears here in the term where labor shows up in a multiplicative way. Alpha and 1 minus alpha are the elasticities of output with respect to capital input and human capital input respectively. So they measure these alphas to which extent output reacts if capital increases by 1% or if human capital increases by 1%. And typically a Cobb-Douglas production function is used. This would be a Cobb-Douglas production function in the two production factors, capital and human capital, which means that the exponents add up to 1. This has the consequence that if I double the two inputs here, labor and capital, what I would get is actually a doubling of output here. So we have constant returns with respect to the accumulable production inputs. And finally, A is productivity. So it measures how effective capital and labor or human capital can be combined to produce final output. And this consists mainly of two parts: technological progress as such, so how advanced technologies are in an economy, because if technologies are more advanced, then capital and labor would be more productive. That's clear. So if we produce with the technologies from 200 years ago, we can produce much, much less, even with the same amount of capital and the same workers, than we can today. But A does not only include technologies, it also includes efficiency aspects. So that a country can use the two production factors, capital and labor, inefficiently, but even though it has access to the newest technologies. One immediate example would be the inappropriate technology. So if you have two countries, say one is a large country with huge farms and huge fields, and the other country is a small country with family farms, and you use the same technology, a huge harvester machine in both countries, then of course the huge harvester machine would be much better suited to the country with the large fields than to the country with the family farms, where you may have very small fields and the harvester machine is perhaps even pretty useless. Then these two countries would have access to the same technology, but this technology can be much less efficiently used in the country with the smaller farms. So A also includes efficiency aspects. And what's typically done in economic growth theory is to look at how per capita GDP evolves. So if we divide this expression by L, we get per capita GDP. If the underlying production factors increase, and to explain why these underlying production factors increase. So why there is capital accumulation in the country, and whether capital accumulation can lead to sustained increases in per capita GDP over time. In the Solo model and in these frameworks, you will see that capital accumulation can only explain economic growth over the short to medium run, but not in the long run. For growth in the long run to prevail, you need technological progress. Right? And what you can also do with such a production function approach is to explain differences across countries. So you can take two countries, a country with a high income and a country with a low income, and ask why they differ. And what you will typically see is that the country with a lower income level has a lower saving rate that leads to lower investment and lower capital accumulation. So the low income country would have a lower capital stock. It would also typically have a lower human capital level because the average years of schooling are lower, the quality of the education system is lower, and so on and so forth. It would have a lower level of technologies because the technological frontier countries, they invent the new technologies and then they are typically protected by patents for an extended period of time. And even if patent protection is over, then there are technology diffusion barriers across countries. So the technologies that low-income countries use might lag behind the technologies of high-income countries. And finally, the efficiency of the use of production factors may also differ due to institutional issues, due to the issues that I explained before of inappropriate technologies, and so on and so forth. So to summarize, what we can do and what many of the videos afterwards do is to explain either economic growth based on a framework of such a production function, or that explains cross-country income differences based on a framework that is based on such a production function.